we're going to go into recession and therefore we're going to see a collapse. And really what we're looking at is stuff that was already priced in again. So if we look at like imports and exports, we're seeing world trade falling. So here's the Eurozone imports from non-Eurozone countries, right? Collapsed. We've seen that everywhere. We know this information. This information was essentially that fall in the ISM. There's nothing new to know here. Yes, economic growth is incredibly slow right now. Yes, many countries are in a recession. Yes, some will avoid a recession. I do think the US is in a recession now, and it's a mild one. But that's what we see from this stuff. Also, if there's a recession, you see jobs falling. So here's job openings. Now, job openings are coming off sharply, and they will continue to come off until they get back to some sort of trend.
The U.S. Federal Reserve, in its recent decision, opted to maintain interest rates at their current levels. However, they adopted a more hawkish monetary policy stance, reflecting a growing belief among officials that this approach can effectively combat inflation without causing significant harm to the economy or resulting in substantial job losses. According to the updated quarterly projections released by the U.S. Central Bank, there remains a possibility of one more interest rate increase within the year, potentially pushing rates into the range of 5.5% to 5.75%. Furthermore, the Federal Reserve plans to maintain significantly tighter monetary policies through 2024 compared to previous expectations. Federal Reserve Chair Jerome Powell, during a press conference following a two-day policy meeting, emphasized the public's aversion to inflation and asserted that the Fed is committed to addressing it. Powell indicated that they foresee the inflation battle extending into 2026. However, he also expressed confidence in a robust economy with sustained job growth, allowing the central bank to apply additional pressure on financial conditions through 2025 while minimizing adverse effects on the economy and financial markets, as experienced in previous bouts of U.S. inflation. In a related discussion, Raoul delves into the labor market, unemployment, and their connections to the Federal Reserve's hiking cycle.
Everyone frets over this bloody stuff every month, and really the forward-looking indicators have been calling it all along. It's going lower. Just takes time. These things are lagged, if you remember. Wages lag ISM, and they will eventually keep falling, and then we'll start getting negative prints, and people will suddenly wake up and smell the coffee, much like we've seen with the unemployment rate. It's like, oh, it's ticking up now. So it does come, but it takes time. And by the time non-farm payrolls are negative and inflation is below 2%, well, the market's well looked through this, and it's looking for the recovery. But it also means that the cowbell, the monetary stimulus, the printing, and even the ability in an election year to add fiscal stimulus grows. And I think they want that. I think they want the excuse to stimulate. And I'll come on to why, but the election side of the cycle, of course they do. They always do. Politicians just want to hit the print button, give you money, vote for me. That's the way the world works, sadly. So the unemployment rate. So this is an inverted unemployment rate. So as this goes down, unemployment rate rises. Our GMI unemployment index leads by 3 months. It's suggesting unemployment is going to rise about 1% from the low. So we're starting to see that happening. So unemployment should start ticking up. Now, if unemployment's rising and inflation is falling, ding, 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 more cowbell. More cowbell, yield curve, interest rates start falling. Remember the financial conditions index? The dollar starts weakening, and what we get at that point is the financial conditions index showing further loosening, and that drives the next leg of a bull market. So I think the market continues into the end of this year. Then it might have a soft patch as the financial conditions index, which is forward-looking, slows stuff down, and then from the cowbell, we'll see it going forwards. I'm not focused on the volatility part. I'm in this cycle for the full cycle, which I think goes into 2025, maybe even to 2026. So it's kind of for me as you strap in and ride the trend. And I'll talk about what assets in a bit. Okay, the other thing to know about unemployment rate is every time it rises by 0.5% from the low, the Fed cuts. Every single time since about 1950. Now, you might say, but unemployment is crazy low right now. And that's true, but it doesn't necessarily lead to wage rises or ongoing wage rises. Japan has had very low unemployment. In fact, for the last 10 years, gone 10-year older population. It's had unemployment at 3.5% or lower, basically, barring a couple of recessions, for extended periods of time. And that's because as their older population leaves the workforce, the younger population has jobs, but they have to compete against friendshoring, offshoring, and technology. So wages over time still never really rise. So yes, we get some wage rises pushed through because of what happened last year, but generally speaking, we don't see any evidence of sticky wages or wage rises or some wage price spiral, any of that sort. It's just not evident in any of the data.
Indeed, it is anticipated that monetary policy will maintain a slightly restrictive stance into 2026. This is expected to occur while the economy continues to grow predominantly in line with its estimated trend level of approximately 1.8%. Despite this growth, inflation is projected to decline throughout the remainder of 2023 and in the years to come. The Federal Reserve foresees only modest initial reductions to its policy rate. This implies that the expected half percentage point rate cuts in 2024 would, in effect, result in an increase in the inflation-adjusted real rate. Continuing with his outlook, Raoul particularly emphasizes that, in his opinion, the United States is not currently in a recession and that the economic situation remains relatively stable and mild. Now, let's return to the video.
So now we've established that we think that the economy is currently in recession. We think it was priced last year by asset markets, and therefore they are looking forwards. Our financial conditions index, which is 9 months in the future, has been going up for a significant period of time. That calls exact timing of the low in the ISM. The markets exactly followed suit. The liquidity cycle is driving. Here we are with a slow economy. Here we are about to see unemployment rising, non-farm payrolls falling, and inflation falling, and an ongoing deflation in core CPI. That is exactly the set of circumstances why I think the Fed was so late with the rate cycle this time around. Because they want these things to undershoot, because what they need to do is debase the currency to pay the debts. And this is something I've talked about in the Everything Code. So let's not get ahead of ourselves. First, liquidity. Liquidity matters. And our GMI Weekly Global Liquidity Index actually lags our Financial Conditions Index by 5 months. So that's very useful. It tells us liquidity is going to keep rising. It's going to keep rising well into 2024, where we might get this little air pocket. But don't concern yourselves with the wiggles. They don't mean a lot. Overall, directionally, we should be headed much higher in the global liquidity cycle. So that's what I'm expecting. So therefore, I cannot be a bear, because if there's excess liquidity, you're debasing the currency, so optically asset prices rise. And the assets I'm long are the secular trending assets. So those are the ones that naturally go up, like the NASDAQ and cryptocurrencies. Those ones are in a natural secular cycle, so they will continue to go up. Now, some of you might go, well, NVIDIA, that's so expensive, it's overvalued, blah, blah, blah. I don't care. It's liquidity that drives everything. We only need to worry about that stuff at the end of the next cycle, when inflation is coming back and rates are going back up. We're the opposite of that right now. We've got a lovely 18-month period of rate cuts, stimulus, and all of the good stuff. That's what you should be focused on. You shouldn't be focused on these other red herrings. They only matter when the cycle rolls over, and that's not for a period of time. So here's another longer lead. This is our GMI Weekly Global Liquidity Index versus ISM. So ISM has a 15-month lead because of the cyclicality of the global economy that we've talked about before due to the rate refi cycle. Well, that suggests that all of 2024 liquidity is going to be rising. So we've got a great year to come in 2024, all things being equal.
In June, Federal Reserve officials had initially projected a full 1 percentage point rate cut for the following year. Powell expressed the Fed's willingness to proceed cautiously with future policy moves, emphasizing the ongoing uncertainty surrounding the central bank's efforts to combat the most significant inflation surge in 4 decades. Powell underlined the need for convincing evidence that the appropriate interest rate level had been reached to bring inflation back to the Fed's 2% target, a decision yet to be made. Inflation, by some metrics, remained well above the Fed's desired level, but Powell noted a diminishing pace of inflation across key sectors. Following the release of the latest Fed projections and policy statement, bond yields surged, and major U.S. stock indices declined. While Powell maintained his stance on inflation, there was a notable shift in tone, acknowledging a growing sense among U.S. central bankers that a soft landing might be in progress, although he stopped short of making it the Fed's baseline scenario. These developments were marked by projections showing that the median expectation among Fed policymakers was for inflation to continue decreasing while GDP growth remained steady, and the unemployment rate stayed below 4.1%. This deviated from historical patterns and the forecasts of many economists. Even the Fed staff had, until recently, anticipated a recession this year, a typical result of successful inflation-fighting measures that dampened spending, investment, and joblessness. Feel free to share your thoughts on Raoul Pal's perspective regarding recession projections in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.